stock markets pulled back for one day and then ripped straight to new highs. Earnings kick off this week with the banks, and bond and commodity markets react to the CPI print that beats expectations. All this and more in this week's Macro Insight. Okay, welcome back to Macro Insight, guys. Today is the 13th of July, and let's take a look at markets. Last week, we had been flagging some caution, seeing some sort of bearish divergences in the market under the hood, things like the breadth not really being there on the rally, very narrow rally and leadership of that rally. And we did finally get a bit of a pullback, but it lasted one day. But markets, and it was all asset classes as well correcting. You had a higher dollar, you had, weaker commodities, weaker equities. And, you saw China signaling concerns over their economy and talking about easing, whereas normally easing would be met with some kind of bullishness, I'd say the market was a little bit taken aback and saying, how bad is it that you need to talk about easing already? When the rest of the world is still like coming out of the issues. So that was a bit worrying. But they basically talked about liquidity support. Obviously they dropped their reserve ratio requirements and things like that. So at the margin, that is easing in China. You had the Delta variant of COVID popping up all over the place in Europe, signaling potential restrictions ongoing. Again, that was something the market was caring about. And then you also had the oil move, which spooked markets a bit as well. So a combination of all those things kind of led to the drawdown last Thursday. And the yields broke lower as well, right? So you had yields breaking lower, taking us down to about 127 on the 10-year. And, that's basically, whereas yields coming down, people have been saying that's kind of a signal that inflation has peaked, and that's not necessarily a bad thing because that puts us in like a more of a Goldilocks scenario where we get growth, but we don't get too much inflation and everything's great. Market kind of starting to think maybe actually growth isn't quite as rosy as we thought, right? So let me share a couple of charts. So here you've got a chart that kind of shows us global economic surprise index. So this is something Citi puts together, and this is the global one. So tracking all of the major countries. And as you see, the 10 years kind of arguably tracking that. It has periods of tracking that, and you see as that's rolled over, as that white line, is rolled over pretty aggressively. You've got the 10-year treasury kind of following it basically, right? So seeing at the margin globally, economic data deteriorating, okay? And 10-year yields crashing down, kind of reflecting that to some extent. Then another sort of thing is inflation break-evens. So you can see here, you've got 2-year, 5-year and 10-year. And you've got obviously the green line is the yield using the opposite axes. So we see that kind of peaked in May as well. So that's what I was saying, the Treasury's move has been kind of reflecting the perception in the market that inflation's peaked. And now we're starting to see inflation break-evens come in. And particularly the one that was kind of stubbornly staying high with the 2-year, saying that we're going to get inflation in the short term, even that has kind of rolled over a bit, basically, right? So that's kind of the bond market has been confirming the view that inflation isn't really going to materialize, and also growth deteriorating at the margin. Okay, so that kind of explains why we're seeing some of the weak price action in the market. But then true to form, what did we see out of the S&P? So we saw this kind of sell-off happen on Thursday, where we went from those all-time highs at 43.65, crashing down to just below 4,300. And that was a key sort of area, right? That 4280, 4,300 area was being flagged as the kind of the gamma flip zone that we talk about when we look at all these positioning indicators for spot gamma and stuff. And that often acts as either an acceleration point or a support level. And it was kind of, we were at this tipping point where if that level broke, all hell's likely breaking loose and we can get another 50 to 100 points quite quickly. And God knows where the VIX is going to go, right? So that level held like it needed to, but it held in dramatic fashion. So, you know, we, within a day, the very next day, we got back to the highs and even through them, right? So S&P rallying really hard, taking the S&P back towards, you know, getting close to 4,400. And that seems to be the new area of stickiness as we're going into this July expiry. That seems to be the zone where the street owns the most gamma again. You know, it's always those kind of 102, 103 calls that the market gets given a lot of. And if we go there for the next expiry, that's kind of where we tend to get stuck. Yeah. As usual, the rally was led by tech. You know, underweights in tech have been kind of creating a bit of a short squeeze lately. But that does seem to have been addressed, right? And further evidence of that being addressed is in some surveys from Bank of America. If we look here, you've got, you know, fund manager survey telling you kind of where the positioning lies or how it's changed. So you can see the June bar is the lower bar, where the positioning was in June. It was very much in commodities and Bitcoin and things like that. And then in July, you can see there's been a shift towards long tech stocks and out of commodities, right? So definitely some signs there that the underweight in tech has been addressed. And then maybe that takes some of that fuel away from that tech rally now that it's come up so far. I mean, tech earnings are going to be towards the end of this month. So that's probably going to be the next kind of catalyst to see where tech wants to go from here, basically. But it's had a very decent run. Yeah. What else? Obviously, we've been flagging the poor market breadth and the bearish momentum divergences last week as warning signs. But you know, the price action remains incredibly strong. We get these very very quick pullbacks. But even in the face of a pre-earnings blackout period for buybacks, markets still managed to find buyers from somewhere, and it managed to rally back, right? So just fighting the rally is becoming a bit futile, it seems. And the divergences, you know, they're not just technical divergences, right? So if you look at some of the fundamentals, you know, you're looking at what, you know, the macro data that's coming out, and this is the US City Surprise Index in orange versus the S&P, and it's just completely going in opposite directions, right? US economic surprises just continue to implode, continue to disappoint. S&P keeps marching higher. Now, could you rationalize that and maybe say we're in this weird situation where the more the economic data disappoints, the more fuel the Fed has to remain loose, and that's just driving equity prices higher? I guess that's really the best way to rationalize it. Okay. So, you know, it's hard to see what's really going to rock this market. We've got July OPEX this Friday. Like I say, you've got your usual concentration of dealer gamma in that 4,350 to 4,400 area. That's so a low vol grind is probably going to be your most likely outcome into that expiry, right? I think it's going to be hard to shake that gamma off. We're going to need some pretty dramatic reason to do that, I would think. Now, the VIX, however, couldn't really get back below 15. Yeah, so you had, obviously, last time we were testing the highs, the VIX briefly got onto a 14 handle. But this time around, where we've made new highs, we're seeing the VIX kind of finding a floor around more closer to 16 at the moment, right? So you see the VIX here making higher lows, which is interesting. Okay. Often, as we said, when we see markets higher and VIX higher, that can be a bit of a precursor to you know, something bubbling under the surface, and maybe we're going to reverse direction at some point. Now, I think the lack of breadth in the market is probably helping that scenario where the VIX isn't really going down. But, you know, kind of need to wait and see what VIX does this week. What we got? Potential sign. Normally going into options expiries, the street does tend to get a hit in volatility, right? It tends to get a hit in Vega. And basically that's going to drive implied vol lower and drive the VIX lower, right? In theory. But given the market anticipates that usually and knows that flow's coming, the fact that the VIX is holding above 16, I think is quite noteworthy, right? So we've also got VIX expiry next Wednesday. Normally you have VIX expiry 2 days before the regular monthly expiry, but sometimes on some months it happens the week after. And often that also means that you get a bit more overhang of vol selling to be done into that VIX expiry. So for me, whilst I'm kind of careful on the market, I'm certainly not overly exposed on the long side, but I think that before sort of buying a load of vol or really trying to take a bearish position tactically, I'd probably wait to see that VIX expiry out the way, because we might then print a local low in volatility around that VIX expiry, which is kind of often what happens. If you look at kind of the cycles of how volatility trades throughout the months, often that VIX print, that VIX expiry often signals a bit of a low in volatility, right? So that's kind of something I'm watching for. And as I previously mentioned, the VIX may start to be supported due to the timeline of taper announcements likely to fall around Jackson Hole, right? So if we have a look at this chart again, kindly put out by Bank of America research team, this is like a timeline. This is in your report that you get. This is a timeline for, potential tapering. So they're saying the end of July, hint at taper signal at the upcoming meeting. Then they're going to look at August, July minutes to discuss the taper timeline. And Jackson Hole set up for a September announcement. So kind of signaling that they're thinking some sort of announcement, either, an indication that the announcement will happen at Jackson Hole, or that September meeting for the actual announcement on tapering, basically, right? So that's and if that is going to be the market event that everyone's focused on, that's arguably going to probably support the VIX level and maybe prevent us from really cracking down dramatically below 15 on the VIX as we get closer to those deadlines. Yeah. All right. So that's kind of where we are in US markets. What else? European markets. European markets sold off a bit harder last week, obviously with the Delta variant, and also generally European markets seem to be a bit more impacted by what's going on in China. So the DAX, Eurostox, etc., took a bit of a hit, but actually they've recovered pretty hard, right? So you can see the dramatic sell-off. The recovery took a little bit longer than a day in Europe, but even now we're kind of charging. Yesterday we had a proper rally, probably helped by the fact that Lagarde from the ECB was sounding more dovish with regards to monetary policy accommodation, saying it's going to get extended like next year. So I think the market took that relatively well in Europe. But Europe's still got some question marks. That SXTP index that I track now to kind of keep an eye on the COVID story, that's still relatively weak and rolling over. So that doesn't bode particularly well. I mean, we may still continue to get deteriorating news on that front, right, in terms of the reopening for Europe. And then China, on the other hand, China's still remaining pretty weak, like the weak spot really in markets. Bring up the China, one of the China indices, no real sort of bounce or meaningful bounce or recovery there. Despite the PBOC easing last Friday. Now that easing might be a sign that we're approaching a bit of a low in what we call the China credit impulse, which is like, let's say, the rate of change of credit growth in China, which has been, a bit of a leading indicator in the past, certainly for commodity markets. If they're now starting to ease, then the next 1 to 2 months could be a bottoming process in that credit impulse. And that's going to have repercussions later down the line for the likes of commodities and other asset markets. So something to keep an eye on there on China credit and how it impacts commodities. However, the beaten up Chinese tech sector, people who are looking to dip their toes in that, I would say it's pretty risky right now. Like the K-Web's probably a good place to look here. Obviously that chart has been ugly, but after what they're kind of doing in regards to cracking down on, you know, companies that are trying to issue ADRs and the stuff like that in the US, you know, piling into any of these type of names, I think it's pretty risky, and you're taking on a load of regulatory risk, right? Some people are suggesting, you know, you can get a similar type of exposure rather than going into those Chinese sort of ETFs. Maybe you go into Taiwan semiconductor as a bit of a tech play for Asia there. That's got a bit of catching up to do if you compare it to things like the SOX index. So that might be one way of playing that trade without taking on quite as much risk as going into China. Yeah. So that's kind of where I am in equities. So, you know, still relatively cautious on this market, not really believing that the rally's got a lot of upside from here. You know, maybe it's got some more squeezing to be done. We've got earnings, obviously. This week, we've got a lot of earnings start kicking off, right? So macro is going to take a bit of a back seat. We've got JP Morgan and Goldman's today. If they haven't already announced, I'm not sure actually. We've got Wells Fargo and Citi to Wednesday, and then we've got Morgan Stanley on Thursday. So a lot of the big banks reporting. People are going to be expecting relatively good numbers for Q2. But I think the thing people want to know about is, you know, what does lending growth look like, and what's the guidance look like going forward? Basically, in a market that we think growth is kind of rate of change of growth is kind of decelerating. So we kind of want to know more on that front, right? And how the price action in these stocks post earnings is going to be quite telling, right? So if we get big blowout numbers for Q2, beating expectations, but stock sells off, then that's going to have some information maybe embedded in it, that price action. Yeah. On the macro front, like I said, we do have CPI that just came out printing pretty high actually. So the market's kind of had a little bit of a wobble on that high print. We'll see how it digests it once the US comes in and what yields want to do and things like that. But you know, that literally just hit the tape. Outside of that, the macro is relatively, I mean, you've got US Empire Manufacturing on Thursday, you've got retail sales on Friday. So they're important data points, but I think that's going to take a bit of a backseat to earnings this week. Okay? Okay, so that's kind of equities. If we move over to FX, DXY just had a big spike after this latest CPI print. So if we bring up what DXY has kind of been treading water all week, was holding on to that 92 support level. It's got a stronger one at 91.5. Those levels were being respected last week, despite risk assets kind of being quite buoyant. As long as those supports hold, my base case is for a test of 93.5. It looks like, you know, this latest CPI print is kind of giving us a bit of fuel for that sort of move towards there. But what it does at 93.5 is really going to be very important, right? That's a resistance level. If that fails and we kind of stay in the range, and nothing too dramatic is going to happen. If we break that 93.5 level in DXY, then that could propel us maybe towards the kind of 97 area at some point, which is probably going to cause a bit of havoc for broader asset markets, yeah, particularly commodity markets. So keep an eye on that level 93.5 on DXY, but you know, that's kind of where I think we're most likely headed in FX. Yeah. Commodities, pretty interesting again as usual. Oil had a big pullback last week. You know, after OPEC failed to agree, we had the spike up towards 77 on WTI. And then literally within a day or two, we were hitting 71 on the downside. So major reversal there. People pretty much saying, okay, maybe a bit of position squaring, maybe a bit of fear that because they couldn't reach an agreement, are we going to go back into like, you know, a price war type thing where people just like reject OPEC and do what they want and turn the taps on? That was the kind of knee-jerk sort of fear that was kind of triggered there. I mean, we've now bounced quite nicely off that level at 71, back into the middle of the range at around 74. And, you know, I think that once OPEC stopped bickering, the fundamentals are still pretty intact for oil. So we probably are going to head back sort of trending up towards 80 as we have been doing. But, you know, if we do get a spike in the dollar, broad-based commodities maybe sell off, could oil kind of get dragged down with that for sure. But that's probably going to present you buying opportunities, right? So my sort of zones that I've been looking at to kind of get into oil are here. So, the first support was 71. I didn't actually buy it there because it happened a bit quick and I wasn't quite ready to dip my toes in there. There's another level at 69.80 and another one at 67.5. I'll be watching for those sort of levels. If they get tested over the next sort of month, if we do get any kind of risk asset weakness, then that'll probably be a nice place to start dipping your toes into oil again. Yeah. So that's my views on oil. In terms of gold, it's been relatively quiet on gold. It bounced off that 1750 level, but then kind of has been, struggling really to get above that 1830 area, which we called a resistance zone last week. And that despite the fact that real yields did turn south again. So normally you'd expect gold to kind of track real yields better than it has been doing. But at the moment, the relatively strong dollar also seems to be impacting gold on the negative side. So gold not really managing to gather any momentum above and get itself above that 1820, 1830 zone, which I've kind of flagged as the key sort of hurdle right now. If we were to break 1830, then actually probably the best trade to play a rally in gold, if you think you're going to get a continuation of that rally, is in the higher beta stuff like GDX, right? So if we bring up this chart here, you've got GDX and the TIPS. So TIPS is just, the inflation protected bonds. So kind of the opposite of what real yields are doing, right? So in theory, GDX should be tracking better what these TIPS are doing, and they're kind of moving in opposite directions right now. So if gold does break that level, then there's potential catch-up trade here in GDX, and it could have some serious beta to the upside, and you're probably going to get more bang for your buck buying that than you are buying just gold outright, basically. Yeah? So maybe some alpha you can capture if you get that confirmation of that break in gold. Rather than just buying gold, you buy this GDX thing for a short-term tactical long, basically. Yeah. So that's what's going on in gold. In terms of other commodities, copper, I had said I thought the rally in copper was probably going to fizzle out, and that is what happened. So far the downtrend has been intact. Bring up the copper chart here. So, it popped up, literally just touched that level there around 440, rally fizzled out, and so far that's contained it, right? So copper kind of struggling to really break above that downward sloping resistance line. Obviously, fundamentals with China doing what it's doing, and arguably there's risk. Excuse me. Arguably there's risk on terms of fiscal infrastructure plans, maybe disappointing to the downside over coming months. So there are some risks to the copper scenario short term. But positioning wise, I think there's been a lot of squaring of positioning, right? So it's kind of a bit of a balance there. I'd like to see copper test 385 over the next month or two. Like I said, if we've got a broad risk asset sell-off and we've got a dollar spike, to see copper down to 385 would be a nice consolidation of this bigger, like longer term up move. And then, you'd feel good about maybe adding some tactical longs in copper at that level. Right now, not really touching copper from the long side other than my long-term holdings. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.